Pleasure to have Barry Maas leading today's webinar on derivatives and the different components. Barry brings a diversified trading background, having started his career in the equity space as a high-frequency trader, followed by transition into the world of commodities. The aim of today's webinar is to address the notion of risk and what it really means to the different players in the market. At the end of the webinar, we will open the floor to questions, so please feel free to use the chat and post your question to host only, and we will try to answer as many questions as we can. With this said, Barry, the floor is yours.
Excellent. Thank you, Xenia. Thank you, Guillaume, for the start of the webinar and your introduction. I'll be presenting some slides, so do a quick wave so everybody has had the opportunity for a visual, and then I'll move to the slides here. So bear with me 1 second. Yeah, so excellent. And once more, thanks for the introduction, and also thanks for the entire SCTA Council, really, for giving us the opportunity to speak at this webinar on behalf of ETG, Export Trading Group. As mentioned by Xenia, my name is Barry Maas. My current role is Head of Directional Trading at ETG for coffee and cocoa. We're a team of 2 right now. That's myself and Xenia, who came over from Starbucks last year. We are looking to double the desk in the course of this calendar year, aiming to add also the other soft commodities of cotton and sugar to our scope. As mentioned, I started in markets outside of commodities, so I started trading and risk management in 2002 for a high-frequency trading house, trading options on equities and on indices, the Euro Stoxx 50, the German DAX index, amongst others. In 2013, I made a move into commodities, where I started trading cocoa for charcoal, cocoa, and chocolate for 6.5 years as a senior derivatives trader. So I've been mainly involved, obviously, with my background in the paper side of trading, as we call it, so the futures and options side. And now I'm 1.5 years almost with ETG, where I was introduced to the beautiful market of coffee, but relatively, I'm only a short period of time active in this beautiful space. But the good thing is, it feels like I've been able to gain 10 years of coffee trading experience in the past year alone. As we all have seen, well, what did we not see? The Brazilian real at 4 when I started, and almost at 6. We've seen the biggest crop ever in Brazil. We've seen the most severe drought in decades. A structure on the terminal in Kerry and in Nimbus, hurricanes, political unrest, the pandemic. So we've seen it all, and I think that goes for all of us in the call today. A lot of things has happened in past year, which is also a demonstration really of the overall relevance of risk management. And we would look to well, give a bit of an insight in how the futures market, the paper market, as I refer to it, plays a role in that. Yeah, so very briefly on ETG. It was founded in 1967. It's a diversified agricultural conglomerate who owns and manages a vertically integrated supply chain, as you can see, across 5 continents. Now, it's been around for a long time. It's growing, 7,000 employees. We're touching 8 almost, focusing on warehouses, processing plants, and 7 million plus is almost 8 million metric tons of commodities moved annually. So we have a nice space in the commodity trading environment. We're not the biggest yet, but we're growing. It started with focus on agricultural inputs back in the 1960s. And we can say that ETG has a large global presence, especially with a focus on the African continent, and basically active throughout the entire supply chain, with focus on the entire supply chain, assets, logistics, shipping, processing, manufacturing, warehousing, and even a retail brand, mainly in Eastern Africa and Southern Africa. And then obviously physical trading of many commodities and derivatives trading around it. So we have a two-tiered business model, which is really trading physical and around assets, and trading also for a part directional in the spaces where we're active. That's coffee, that's sugar, cotton, oilseeds, grains, energy, freight, wheat, just to name some of the ones where we're active. Now, as discussed in the intro already, a bit of the agenda. So what we thought would be a good idea is, especially for the people who are mainly active on the physical side, to have a little bit of a deeper dive into the derivative side of things. For some, it might be partially basic. Some elements we will go over quickly, but I think it's a good step to look into okay, how do the futures market play a role in the physical, and vice versa. So we'll go over the market participants, whether that is a three-party environment, yes or no, risks involved, and how trades plays a role, and how the futures allow for price discovery and hedging. We thought it would be a good idea to discuss a bit on the COT, the commitments of traders, and finally a bit more technical, maybe briefly on options and their sensitivities. The idea there is basically probably everyone is receiving broker reports and reading the daily reports, maybe sometimes a bit technical comments. What do they actually mean? What does that imply? And how does it relate to our markets, really? So moving forward, I always try to look at the market in the simplest way as possible. So when I just started in commodities, I was thinking, hey, is the marketplace really a three-party or a tripartite environment, where it's very basic, where we have origin selling and providing basically hedging pressure on the futures market, and it's the consumer or the roast buying it in the end. Those are basically the flows. Now, a lot is happening in the middle. Why is it a three-party? Because we have only two commercial participants right here in front of us. Oh, sorry, wrong direction. We have a third party right there with the speculators competing with one or the other. The speculators are buying. You can argue they're a competition for the roast. If they are selling, they might jump the queue and are competing with the origin who is looking to sell. Now, that can be nasty at times, where they are competing with one or the other side of the commercial equation, if you like. At the same time, they play an important role in providing liquidity, because often origin selling is not happening at the same time when roast or consumers are buying. So providing a liquidity here is really allowing people to be active in the market and balancing the flows whenever people are looking to do so. At the same time, it's providing really a benchmark for the pricing. That's what the futures market is doing. We have a very transparent system with an exchange in place, and we can see not only by the day what are the settlement prices, but by the minute what is really the base price for the coffees that we are trading, which is derived of the futures market, both in Robusta and in Arabica. Now, obviously, there's more players than only three, but this is my very simplified way of looking at things. Of course, I would be doing short to the trade, who often is in between those two commercial parties And like the speculators are functioning as a liquidity provider on the future side, on the paper side, trade is doing so on the physical side. And I try to visualize here how the futures market is purposing as a hedging tool, where trade is really, and you can see that a bit smaller on the left-hand side, is buying differentials from the origin, looking to take up a differential position, another directional position per se, and selling out futures in order to, well, to hedge the price risk that they are running, being left with a long differential position in this example. Now, what they do as a next step, they sell those differentials to roast, and simultaneously in normal conditions, in case of not having a view, buying back the futures to again offset the price risk that they have created by doing so. In the end, it's very basic. They bought differentials, sold the futures, they sell differentials, which then get fixed and buy the futures. So bottom line, they're left with a differential position that is neutral, as well as a futures position that is neutral. So if we look at it as one single trade, that is basically where the margin is coming from this one simplified transaction. Now the same goes both for origin and roast, obviously, where they can use the futures market themselves as a hedging tool, where either exporters or even professional farmers level short futures can be taken to lock the flat price component of the final coffee, and roast obviously taking futures as a cover for hedging price increases, as we see. Now, I'm talking about the trade here and the margin that they make. Now, the margin is there to obviously make a profit, but also to compensate for the risks that are being run. And I think these are risks that everyone is involved in, regardless on what side of the coffee trade you are sitting. I think this goes for roast, this goes for origin, and obviously for trade in between itself. I'll start at the top and then we go clockwise. Obviously, I briefly touched upon it, the differential risk. Am I going to buy or sell ahead of the customer? Do I prefer a long or a short differential over here? But that comes with risk. Obviously, counterparty risk is a key element here. What we need to know is if you buy coffee on a flat price and you sell futures against that to hedge your flat price risk. Well, I think we all read the headlines quite recently about default risks. Yeah, what do you do with your futures if there's a risk of defaulting and the counterparty is not delivering according to agreement? Now, spread risk is an important one. I think everyone in the coffee trade is exposed to that. What we see in coffee is that there's often a carry in the market, which allows to carry physical positions. But we, as I mentioned in the intro, I've seen an inverse last year, I think in March, when there was really a pipeline filling on big demand in home consumption. So you really need to decide, where am I putting my hedges? I know people also in cocoa, but some people I speak to who assume that wherever the coffee is sold over or over which period, that's where the hedge is being done. But it's obviously up to the people who buy the coffee to place their hedges where they think they should do it. If the market is in a full carry, it's unlikely to put the hedges really on the nearby, but more likely to carry it forward towards positions. Now, logistic risks, I think those are very apparent right now. We've seen issues in ports due to COVID, container availability, strikes or political unrest. So that's elements to deal with. I think financing is very clear, especially also last year when the pandemic broke out, a lot of institutions halted their financing effectively overnight. Obviously, you're exposed to interest rates. How do you deal with those risks? Will you hedge that, yes or no? And then there's hedging risk or hedging costs, especially people who hedge in the book of trade or otherwise, and don't run a futures book directly. It's good to be aware that there's different risks and hedges, or different risks and, well, direct or indirect costs to hedging. Liquidity, as I was mentioning earlier, is very important in the futures market. So the liquidity is deciding the ability to properly hedge your positions and exposures. The bid ask, so how wide is the price between buying and selling, is relevant there, because there can be decent slippage when you need to hedge. Then there's direct costs, exchange and clearing fees that are involved, and maybe tied towards financing. We have margining costs. If I, as a trade, would buy coffee and sell futures against that, if the futures market is showing an upward move like it has done in the recent months, I'm obliged to put more margining in my account to account basically for the mark to market, as we call it, the losses that I make on the futures that I have short in the book. So all in all, quite some variables that we all have to look at on a day-to-day basis. Some you can hedge, some are really hard to hedge, but there's plenty of risks involved that require risk management of many of us active in the market, both on the physical side and on the paper side. So now that we discussed some of the participants that are active, we thought it would be a good idea to briefly discuss the COT, or the commitment of traders. That is basically a reporting done on a weekly basis by the US Commodity Futures Trading Commission, the CFTC in abbreviation. And every Friday they publish basically the weekly activity of each participant per category for the week that ended from Tuesday to Tuesday. So effectively, every reporting week runs from Tuesday to Tuesday, or effectively Wednesday to Tuesday, and that is reported then on the Friday after. So it's always backward looking, but it gives an idea on the positioning that we are seeing. And what we see here from on the left-hand scale, we can see the dates, all the dates on the bottom, starting in January to the more recent ones. I don't have the very most recent one here, but basically I decided to show 3 buckets of categories where we have the commercials, the producer and the merchants on the left-hand side. Then in the center we have the swap dealers, which are effectively the OTC traders. So if anyone on the trade is doing an accumulator, for example, that will be hedged and is run into the swap dealer's positioning, or if someone doesn't have a futures account but does a swap, which is a future lookalike, if you like, with a provider, then it will appear in this bucket. And then we have the managed money, or the non-commercial, which are really the speculators. And as you can see, it's split into a long position, a short position, and then the two added up together, giving us the net position. And then it also shows the spreads, basically for some of those participants, showing how they are involved in spreads. But it's a good proxy, I would say. On the producer side, the long, you can use that as a proxy for roster cover in terms of futures. Now, roster can be covered either by futures or having physical to be delivered in the book of trade, of course. But the futures cover is the proxy is really the commercial long, as we see it here. Now, the opposite is the commercial short. So that is either origin by exporters or farmers being short futures themselves, locking in price levels, or trade who have bought physical and has been selling futures as a hedge. Now, what we can see here, and maybe it's better if we switch to this one. This is really historically the commercial short in KC in the Arabica contract. We see a record commercial short effectively if we look back the last 15 years, as we see here on the chart, which is effectively reflecting a record forward sales. So as I said, that's either farmer exporters or trade who bought coffee from origin and hedged that by selling futures. So that is really the short leg. And it's at the record because origin, especially Brazil, has been very keen in locking the KC prices and the BRL as a combination, looking at prices that were peaking above 800 BRL locally, a record in the recent history. Now, another leg is the non-commercial or the managed money or the speculators leg. What we have here in white is the net managed money. So that is the sum of the long and the short. They're individually disclosed by the CFTC. And in blue, we see the structure. Now, KC is structurally in a carry month. You can see the blue line being sub the zero scale. On the right-hand side is the scale for the second versus the 7th month effectively, which is the year spread or carry, if you like, and that is driving a positive yield when short, and that's also why we can see, coffee, unless there is a real storyline, especially in the period 2017, 2018, 2019, have been driving a structural short position. As you can see on the left-hand side, the scale of the positioning. Now, this season is a bit different, obviously. We're close to record length in terms of lots. So this is in lots, 50,000 lots or 40,000 lots equivalent, driven by the KC fundamentals. The demand bounce potentially with the end of the pandemic, the weather in Brazil, and many other elements that is driving that. And obviously, what we are seeing today is a very broad cross-commodity inflationary theme where the speculators in general want to be long commodities to benefit from, general inflation, general price increases, which will obviously also hit our space, the commodity space, and also coffee just in general. Now, what is maybe good to mention is that in general, what we see is that the futures market by the physical players is used to reduce risk, so more as a hedging tool. By the speculative positioning that we are looking right now, or the managed money positioning, it's more often to assume risk or speculation, obviously. Now, maybe good to briefly mention some of the speculators that we have. Those are hedge funds that just have a pile of money that need to make a return and do that in different risk assets. Index funds where all of our pension money is sitting, that needs to manage that money and try to make a return. CTAs, really commodity trade advisors, system funds that are looking to the charts or momentum and are taking a position here or there. Now, and as I said, what is important one is the yield traders, where people are looking to trade one commodity against the other, saying, okay, I have a negative yield or a carry market in commodity A, and I have an inverted market in commodity B, and I'm just going to trade one against the other. Because if everything else stays equal, I'm going to make a return on sitting on that. Maybe good to give a very brief example there. If we look at coffee right now, as we see, the year spread is 8.45. But if we look at the July SEP right now, for example, which has been trading recently around the 2 cents mark, or negative 2 cents, I should say. The way that the speculator is looking at that is basically assuming convergence from U level, let's call it where we are roughly right now, 156, towards the N level, if everything else stays equal, into the 154. What does that mean? If that convergence takes place, and I'm short the U at 156, and it converges towards the value of N, assuming everything else stays equal, then in from July to SEP, so in the 2 months window, the yield alone should give me 2 cents of return, with giving me the ability to sell at 156 and buying it back 154, assuming nothing else is changing. So that is how the convergence of the yield trade is working, and what, well, a lot of the managed money is looking at as one of the inputs. So that's it on the COT. Now, what I think is good to do is go a bit on to options, a bit more technical. I think if we read broker reports, often we see comments around the options market as well, because they're very active in providing services for execution on futures, but mainly on options as well. That's highly liquid, especially on New York a bit more than on London, or Arabica a bit more than on London, but yeah, widely applied both by commercials and by speculators. Very basic. You have two types of options, basically, a call option and a put option. A call option is giving you the right to buy a future with a predefined maturity. So let's call it September, which we refer to as the expiry, which also has an expiry date, which lies in August for September, at a predefined price level, which we refer to as the strike. As an example, I have here the 140 call, which is the strike 140. What is good to know is that an option price consists out of basically two simple components. It has an intrinsic value and it has a time value. So a very basic example on the intrinsic value. If you have a 140 call, and while the future is trading at 160, you have the right to buy the future at 140. So already there you see, if I execute my right today, I can buy the future at 140, sell it at 160, and lock in a 20 cents profit. So that's why we call that the intrinsic value. Now, if the futures market goes back down to 140, there is zero intrinsic value left anymore. If the futures market would go down to 130, then the intrinsic value is zero. There's never a negative intrinsic value. Second, we have a time value, and that is mainly depending on two factors. That's the time to expiration. So the longer it lasts, so the longer the duration, the higher the price should be, and the higher the volatility, the higher the price should be. You can compare that with insurance, really, where the longer your insurance run, the more premium you're forced to pay, and the higher the volatility, or the higher the unpredictability, the higher the price of the insurance. So that goes for coffee, but it even goes for a simple example as your car insurance. If you live in downtown of a big city, your premium is probably bigger than if you live somewhere in the outlands, in a quiet rural area. What is good to realize is that managing risk always has a cost or an opportunity cost. What is interesting is that with the options, it's extremely clear and visible because you pay a fixed premium. Again, just like in insurance, which is required. So it's super tangible. But obviously, if you take cover today, you exchange one risk for the other. You exchange the risk of the market running higher and away from you, if you're looking from a ROAS point of view, for the opportunity cost that you run if the market is moving further down. So that is quite clear. Now, other than with futures, in options, what is really interesting is that both the long and the short holder can make money at the same time. Now, it's important that you're not always fully insured with an option, because as I was mentioning earlier, it has an expiration date. So you could have a situation where you think, okay, I'm going to buy protection to the upside, taking the right to buy my coffee price, my coffee futures at a certain predefined level where I'm happy to own it. But if the market moves there just ahead of the expiration date, then your option expires, ceases to exist. So your insurance is no longer in place. You lost basically the premium that you paid while you have no cover taken, and then you still need to make a decision. What am I going to do? So it's not like you're having a free, unlimited protection right there.
Very sorry to interrupt, but we just got a live question, which I think is pretty nice because it's in reference to this slide. Is it please possible to explain a bit more in depth as to how can both the long and the short holder make money at the same time by holding the exact same option?
Yeah, it's an interesting question. It has to do with hedging, really. So if you have if you and I would be counterparties on a future, and I buy the future at current level, let's call it 155, and you sell the future to me at 155. Well, two things are interesting. One, we will be creating open interest. So if we start a new marketplace, I buy 10 futures and you sell that to me, then we basically create an open interest of 10 lots. I'll be the long holder, you'll be the short holder. If I sell those back to you, then we create destruction of OI and the open interest goes down. If I sell it to someone else, then basically the open interest will stay the same, because I will kill my open interest side of the equation and a new open interest will be open. That is open interest, but I'm buying 155, you're selling 155. If the market goes down 3 cents, I will be losing money, you'll be making money. There's no other way around it. But obviously, if I use it as a hedge, then I can still make money if I have physical against it. Now, with options, in isolation, it is possible for the long and the short to make money at the same time. We will go a bit over the option Greeks and what volatility really means, but it is effectively possible if one person is hedging and the other one is not hedging. Then you can both make money at the same time while being in an opposite position on the futures. I'll go over the Greeks and then maybe I can refer to it at a later stage once again. Thank you for the question.
Thanks very much, Harry.
So, yeah, I decided to take a quick look at volatility and just a very quick explanation on saying, okay, what does that really mean? I hear a lot of people telling to me, I read this broker report and it says 32% volatility, but what does that really mean? I mean, I have no idea. What is important to realize, we have basically two volatilities that we can revert to. Historical volatility or realized, that is really looking back, and in textbooks, that is really the annualized standard deviation of past price movements. And using 32% really means that there's one standard deviation or 86% probability, that's just statistics, that the price of the asset or the underlying, let's use coffee, in the next year, because it's an annualized standard deviation or an annualized expected or historical move, in the next year will fall in the range of 30% up or down from where we are at the starting point. Now, what is interesting is how does that really translate into shorter time frame on price deviations? Now, that is statistics and calculating standard deviations backing towards shorter time frames. But what is a good rule of thumb, an easy way of calculating it, is dividing the volatility by 16 to get to the daily expected move. Now, why 16? It's actually 15.8. That's the square root of 252. You see the annualized volatility on the graphic there. And to get towards the daily expected move, you divide 35 by the square root of 252, which is 15.8. So it's roughly 2% on a day-to-day basis. Now, the second volatility that is known is not the historical, so that's not the looking back what has really happened, but it's what we call the implied volatility. And that is a reflection of how the market in general comes to an equilibrium or a consensus of what they think the price deviations will be in the future for each corresponding maturity. And that is derived back from the options prices that are transacted. And those, as I was saying, are driven by uncertainty, really, which can be historical moves, future events, amongst others. If there's a drought or if we get the GCA like we get tonight, there's a bit of uncertainty in the market. We can expect a little bit of a reaction, or the Fed is talking. That can give us an insight in tapering, yes or no, and it could make a bit of a move. Is the inflation trade still intact, yes or no? And so you can expect, if there's a bit more uncertainty ahead of us, that the prices of options will increase because people who are selling them, well, want to have more compensation for doing so, and then the prices go up. So implied volatility is going up. So that is around volatility and, well, the drivers really of the prices of options. So the higher the volatility, the higher expectancy of the moves that are ahead of us, the bigger the uncertainty, the higher those insurances become effectively. Now, even a bit more technical, but you probably read those also in many broker reports. So maybe good to briefly go high over on option sensitivities, which are referred to by Greek letters, and that's why they refer to as the Greeks. I try to define them very quickly, and also, well, at some trying to explain why they are even relevant. What is good to know is if you have one option, then it's all very straightforward. But if you're a professional options trader, or you're running a wild book of options to manage risk or to assume risk, then these Greeks or these sensitivities are a very easy way to give you a high overview of what your sensitivity is to either flat price, to either changes in volatility, to time passing by. So as we can read here on the slide, a delta of the option basically gives, I see a misspelling there, apologies, how sensitive is your option or your portfolio for changes in futures prices. So it's effectively, the definition is the dollar amount an option price is expected to change based on a $1 change in the underlying future. So very simple. If we have a 150 call option while the KC is trading at 150, then that normally has a 50% delta. So that means if the market moves up by $1, the option will change by 50 cents. Now, the rule of thumb is a nice one to be aware of, that the delta basically gives you an indication or a direction of the probability of an option that it will end up in the money at expiration. That's why if you're trading 150, the 150 option has 50-50 chance. Now, if you have a 150 call, the right to buy at 150, and the market is trading at 160, that delta is changing because the probability is higher, and you probably have a 60% probability of ending up in the money because you're already 10 cents in the money as we speak. Now, again, that is a rule of thumb, but it's good to be aware of how those are looked at and how those affect really the underlying option prices. Now, obviously, if you long a call option, you're long a delta because if the market goes up, you benefit and your portfolio gets a higher value. If you long put options, you're more keen in the market going down, which is reflected in having a negative delta. The next one is the gamma, and that is really the rate that the delta will change based on a $1 change in the future price. So you can say really if the delta is the speed at which option prices changes, you can think of gamma as the acceleration. A bit technical, but I was just giving an example. If the market moves from 150 to 160, that 150 call option changes from 50 to 60% delta. Now the gamma is deciding whether that changes from 50 to 60 or maybe from 50 to 70 or maybe even from 50 to 90%. And that will depend where we are in time. So how long is the option still running? The effect of that is highest near expiration, because you can argue at expiration it becomes binary. You're either going to be, as we call it, in the money and buy 100% of the futures to the size of the calls that you own, or you're going to buy zero. Now, why is that relevant, even for people in the physical and even for people that are not trading options even? What is good to be aware is if we're close to expiration, you can check what is the open interest on each individual option strike price, because it can chase option traders to do their hedges and exaggerate price movements. So as I'm saying, that's why open interest can be of interest also if you're not involved in the options market, to indicate where the interests are lying and where aggravated moves can be expected. Now the other two that are there and is theta. So that is basically how sensitive am I to change over time. Very simply put, it's just time decay, and it's effectively number one enemy for the option buyer, because if I buy an option today at 2 cents and nothing changes, tomorrow it potentially has a value of 190 or 180 or at least lower, because there is less value, because there's a day less move possible, so there's a less deviation possible than there was with 1 day more time of running. Whether it's moving from 2 cents to 190 or to 180, that is really the theta. So how much is my option or my portfolio decreasing in value with the change of 1 day? Lastly, it's Vega, and that's how sensitive is my price of my options to volatility, to implied volatility. As I was saying, the price of the option is driven by the time it is still to go and in the implied volatility. If there's more uncertainty, the price will go up. I was referring to volatility 32%. As you can probably understand, if you move the implied volatility, if the uncertainty is increasing and you increase the implied volatility from 32 to 33%, your option price will increase. Now, how much will it increase? That is shown by the Vega. So it's really the amount an option price will change for a corresponding 1 point or 1% change in the implied volatility. Now, what is important is it's only affecting the time value component that I was splitting up earlier. So the intrinsic value obviously is not changing, whether you make volatility 0 or volatility 100%. If you own a right to buy at 150, the intrinsic value is 10 cents regardless if the market is at 160. What volatility can do is it can drive some lazy options. So you can have a situation where the market moves in your direction. So if you're long puts to protect for the downside move, you would expect that your value is increasing by the delta, as we were earlier discussing, but your benefit can be muted because volatility can move against you. So if you bought an option and the volatility goes lower from, let's say, the 32% to 30% only, then your benefit can be muted, and that's why I refer to it as lazy options. Now, in commodities, that's more often the case for puts, so downside moves. So you will more often see volatility going down if the price of coffee, if the futures market is moving down. Funnily enough, in equities, in stocks, it's more often so for the calls. And that's somewhat easily explainable because the shocks in commodities are more often larger to the upside because you can have a supply issue that is causing a big shortage. Now, an increase in supply can be there, obviously, by better yield or by more acreage, but the impact like we have right now, for example, with the drought, is much more severe than a gradual growth. So the supply shocks or the shocks are more often to the upside in price because the supply can be affected harder on the downside. In equities, that's to the other direction. You can have a bigger surprise to the downside or a scandal that can drive things to the downside. We refer to that as SQ. That is also why calls in commodities are often more expensive than puts. So upside protection in general is more expensive than downside protection. You can see that very clearly if we take an example of coffee at 150. If you would buy a 160 call, so upside protection, that is more often more expensive than buying downside protection to a similar degree, buying the 140 put. That is because, well, the risk is bigger to the upside, hence the implied volatility for the calls is bigger. Now, I don't have that on the slide, but maybe interesting to mention finally before we go to the questions, is that what we are seeing is that CSOs, and you might read about those in reports or several times as well, calendar spread options are finding increased interest over the last years. Those are basically working similar as regular options, but now on spreads. So you really buy a call option on the set deck calendar spread, for example, rather than buying the right to buy the future at 150 for the KC contract. You buy the right to buy the spread, let's say at minus 2 cents. But they work pretty similar in that sense. So that makes it to the slides that I have prepared. I hope that I was able to give a bit of insight in some of the elements around the derivatives market, both futures and options, how it plays a role for the different participants. And I'm happy to ask any if in the meantime any questions came in.
Thank you so much, Barry, for sharing your insights. It was incredibly useful, and we already have a few questions in the pipeline. So starting with the first one is a question: in which market conditions would you choose assuming risk with options as opposed to with futures?
Yeah, that is a fair question. There's not a very straightforward forward answer there really. I think in general, if you're convinced that you want to have cover, then you would move really into futures. I think conviction is an important one. I think if you're doubtful or if the risks are increasing, then I would diversify the portfolio and be more on the options. But obviously, I would be more keen if the volatility is low to be on options. The way I look at options really is it's a potential delayed future. It's a potential delayed future. But what I would always do is have a diversified portfolio. I would lean a bit more towards options if I see more risks and uncertainties ahead. And also right now, I mean, it depends very much on your view. If you think the coffee contract can go to 2 cents, but you are afraid to take too much cover right here in the 150, 160 type of area, yeah, in that condition, I would be willing to put some premium out and play a bit with options more than just futures and locking in everything right there. I think that is
very good, very good. Thank you, Barry. So we have a follow-up question on the skew. There is interest to understand what kind of different information you're able to take from it and what kind of readings is it possible to extrapolate on market sentiment and psychology.
Yeah, so just to quickly explain skew, I touched upon it very briefly. Skew we refer to really as the difference between implied volatility between different strikes. So what is important to know is that options of the same maturity and same strike, so both calls and puts have the same implied volatility. That's why they have the exact same time value, and the only thing that is different is the intrinsic value. Now, let's assume that you have 32% volatility for an option that is 150. Now, what the skew really means is, let's say we use a 160 call option, which is giving protection to the upside, that potentially has a higher or likely has a higher volatility, 35%. And the puts, let's call it 140, so similar distance, potentially have a 29% volatility. So skew is basically the difference between that 160 and that 140 option, which in my example that I gave is 30 versus 35, so 5% more higher volatility for the calls than for the puts. Now, what can you read out of that? Because that difference is changing, well, each day effectively. Potentially, what you can read out of that is the bigger the difference there, the more nervous people are to the upside, because the volatility is really driven by supply and demand, just like the futures price is. So if there's more demand for call options, the price will increase. And if that 5% difference between the upside protection and the downside protection moves to 8% or 10%, that is really a reflection of, well, the market being nervous and seeing risks to the upside. So that is how I would read that skew and that difference really in volatility between different option strikes and, well, the difference in price between upside and downside protection, really. Maybe a final comment. It's not always easy to read what people try to do with an option position. It can be a protection of a futures position. So if someone buys a call, it's not always a bullish sign. You can buy a call because you're short futures as a speculative positioning. So I hope that answers the question.
Thank you so much, Barry. There is a few more questions that we will maybe look to answer separately, as we are unfortunately running out of time on the webinar itself. We just have 1 more minute to go. So with this said, we will look to conclude the webinar. Barry, thank you so much again for your time and for your insights. It's very much appreciated. And with that, I would like to hand it back to Guillaume.
Yeah, thank you very much. As you said, Xenia, I think it was very interesting, a very good choice. So thank you, Barry, for your time and your clear explanations. We hope it's been of interest to the whole SCTA NextGen community on the line. If you have any question, you can of course reach out to us. We will forward your questions to Xenia and Barry without any problem. So don't hesitate to do that. Otherwise, we wish you a great start of the summer. We will communicate to you very soon the agenda for the second half of the year. If you have any ideas or comments, don't hesitate. So thank you very much, everyone. We were around 65 participants today, which is very good. So thank you, Barry, and thank you, Xenia, for the support. Wish you a very good day, everyone. Take care.
Thank you. Thank you very much. Bye-bye.
Goodbye.
Have a good day.
Bye-bye.